Great to have you join us. I'm Ladi Williams. First off, let's look at how the markets are looking at intraday, starting with Africa there. Right behind me, we see the NGX still on the downtrend there, down at 11, and we see the South Africa GSE also in the green, but we see the NGX not down that much. Let's flip over to other parts there. We see Egypt there. It's up 0.18%, and the Kenyan bourse again continuing that negative trend that we've seen for a couple of days now. It's down 0.09%. Let's flip over to the Middle East there. We see it's mostly mixed in that market, the Middle Eastern market there. We see Qatar there leading with losses, but Abu Dhabi and Dubai both in the green. Abu Dhabi index almost up 1%. We'll flip over to the other parts we track there. We see it's squarely negative on that side. Saudi Arabia there down 0.79%, and the Qatari index there, the downest, the biggest downer there at intraday. Those markets still having those bearish trend in the Middle East. Let's move over to Berlin now. We have Daniel Winter standing by right there. Great to have you, Daniel. How has the economic picture in Europe changed this week? It's all about rate hikes.
Well, it's been a mixed picture this week. Some signs are pretty healthy. Just take euro area unemployment figures, which were out yesterday, which fell as expected in September, 6.6%, which is down from 7.3% the same month last year. Good news. Still, the worry is that a recession is on the horizon. Inflation is creeping up, over 10% now in the euro area. Meanwhile, the European Central Bank has continued to raise interest rates, last week deciding to increase its key rate by 75 basis points. So at this present moment in time, it's a mixed picture for the European economy, but the tendency is certainly towards a decline. The most important factors economists are looking out for now are inflation, especially food and energy prices, and any knock-on effect. They're looking at GDP growth to monitor that. Almost across the board in Europe, economists are expecting that the economy will enter into recession. The big question is when and how hard. After all, that will have bearing on whether central banks like ECB continue to raise rates. And if they time those rises poorly, they could risk pushing Europe into a deeper and harder recession than would happen naturally. A big responsibility to navigate, and there's no guidebook to help them.
And what's the recession risk like in other parts of Europe?
Probably not. The governor of the Bank of England announcing it will raise interest rates also 0.75 percentage points on Thursday. That's bringing its interest rate to 3% overall. But that announcement also came with a dire warning that the UK is facing its longest recession in history. He said the bank must act now in order to stop things being much worse later on. Now, it's a similar picture in the rest of Europe. Rising energy prices are squeezing households in part due to the war in Ukraine. But many Brits will also see their mortgage payments increase and their pensions decline due to the previous government's disastrous mini-budget. Most of the worst of that budget has been reversed, but there are still some excess effects which will hit some households in the country while they're already facing difficulties, as the Bank of England announced.
And how are the markets in Europe looking?
Well, this morning, European stocks jumped after strong gains in Asia. Now all eyes in Europe are on Olaf Scholz's trip to China today. Can Germany's Chancellor warm up the trade relationship between the two countries while also avoiding the trap of being too dependent on foreign business, a problem we've clearly seen with Germany's energy dependence on Russia? So all eyes on that today.
All right, that's Daniel Winter right there in Berlin. Thank you so much, Daniel. All right, moving on now to the UK. We have Juliana standing by right there. Great to have you, Juliana. So it's UK car sales. We see it's the weakest since 1982. That's more weak data, but it was stronger from last month.
Yeah, so good afternoon, Laddie. It's a forecast that's concerning investors because we have had data from the Society of Motor Manufacturers and Traders, and it does show that last month was a decent month year on year. New car sales rose 26%, which is good news, but the car expert analysis group does say that, this surge is certainly going to be short-lived, and it's all down to the discussions that we are constantly having, which is the cost of living crisis, high inflation. But what has become a major factor, particularly in recent months, is high interest rates. And high interest rates means that the cost of borrowing goes up. And if you're buying a new car, unless you're as wealthy as somebody like you, Laddie, most people are taking out car loans. And of course, these monthly payments are going to significantly rise. And if you're thinking about cutting back, I think the first thing that most people would think of is not having to upgrade their car. So they have downgraded the forecast next year of about 2.2%, and it really just paints as part of that picture we've been painting of the bleakness of the UK economy at the moment, with the Bank of England suggesting that we are already in a recession and it's going to last for 2 years.
Yeah, quite gloomy projections there. But right now, Juliana, so much happening with Twitter, so hard to ignore. What are you hearing?
Yeah, it's not going great for Elon Musk. In fact, I think this recent spat is not going to bode well for him, particularly at a time where we know that people are really squeezed. We are just getting to the Christmas season. Most people like to keep their jobs around Christmas time, but that's not going to be the case for about 3,500 staff. Literally 50% of Twitter's entire workforce. Even Twitter staff in Africa, here in London. Everybody is really nervous at the moment because there has been no proper announcement, no warning, nothing. It's just that, thousands of Twitter staff have woken up not being able to access their emails. Passwords have changed. They're told that they must hand in any apparatus that they have at home that belongs to Twitter. And that's because, of course, we know that Elon Musk wants to trim the fat around the company that he says hasn't been functioning in the way it should have over the past couple of years. I think some economists are a little bit skeptical of his moves. According to insiders, he is asking, execs at Twitter to make sure they are overseeing savings of about $2.5 million a day. And the skeptics say that's because he wants to get his money back, really, because most people think that the $44 billion price tag for Twitter was well overpriced. And I think, Elon Musk must, of course, agree with that too, because he tried to pull out. So it's not great. The only kind of shining light in this for journalists like us, Laddie, is that it's all being played out, of course, on Twitter, because you've got a lot of very ticked off former tweeps, as they're now called, who are exposing all of these moves on the platform until, of course, they may be blocked. And they're saying, look, Twitter may have been messy. You may not have really liked it, but it was the place you went to when there was breaking news. It is the place we all run to when WhatsApp is down and we all want to check to see if everybody's facing the same issue. And they're saying the problem with, all of these, forced sackings is that you're not going to have people moderating the site, making sure when you go on Twitter, you can see what the latest football score is without having to type it in. You can see what's trending that you would like because of your algorithm without having to swave through a mess. And there are suggestions that is perhaps what we are going to get now that there is a new sheriff in town. So there are concerns, lots of suggestions as well that advertisers are starting to pull. And then, of course, Laddie, it's going to cost us $8 for the blue tick, whereas some people would pay much more to get that blue tick every month. But we'll just have to wait and see. But yeah, not great if you're losing your job just a couple of weeks before the festive season.
Yeah, quite interesting there, because Elon just trying to make all that money so fast. But how are the markets looking?
Well, the FTSE is actually doing pretty well today. It's gained about 100 points, well near that 7,300 level, and that's because of a rise in commodities stock. So it's going to be heading in the weekend up, and the FTSE All Shares boasting triple-digit figures, up by 1.11%. The FTSE 250, the FTSE 100 is up by 1.22%, and the FTSE 250, that's up by just under 0.5%. In the currencies market, the British pound is currently trading slightly up against the US dollar by 0.45%. I think it's on that $1.12 rate at the moment. The FTSE is down against the euro by 0.12%. And at intraday, the British pound is currently trading flat against the Japanese yen, Laddie.
All right, Juliana, thank you so much. Happy Friday. Thank God it's Friday. And enjoy the weekend.
Yeah, I agree.
All right, now let's move on to other markets. Now we'll see Hong Kong stocks briefly rose today with the tech and consumer cyclical stocks driving the surge amid China reopening rumors and reports that U.S. inspections of Chinese company audits were completed more quickly than expected. The Hang Seng index there closed about 5.36% up there. Nikkei 27,199 points up, down 1.68%. We see stocks in the city have been reacting to speculation about a potential China reopening as zero-COVID policies persist, dragging the economy. In mainland China, the Shanghai Composite closed up 2.43% at 3,070 points, while the Shenzhen component gained about 3.20% to stand at 11,187 points. Moving on to other markets now, stock futures rose as investors looked ahead to the October jobs report for clues into the pace of future rate hikes from the Federal Reserve. Dow Jones Industrial Average futures gained 221 points there to 0.9% high, while futures tied to the NASDAQ 100 added 0.9% there from what we see. Let's move over to Maria Bird for yesterday's close.
The U.S. stock market ended lower on Thursday, as many investors were not pleased with the announcement by Federal Reserve Chairman Powell. It is clear that interest rates will continue to increase. As the Dow Jones saw a direct impact, closing at 0.46 down. The S&P 500 closed at 1.06 down, and the heavy tech NASDAQ closed at 1.73% down. This is going to have a major impact on the coming months, as it is clear that interest rates will not stop climbing as an effort to make sure inflation does decrease. Even though the US dollar is shown to strengthen against other currencies, but it's causing major challenges for the global economy.
That was Maria Bird there with yesterday's close. Let's see what's happening in oil market now. We see oil prices climb as dollar ease and supply risks lingered. Though recession fears and China's COVID outbreaks kept a check on prices, Brent crude futures were up about $2.72 to $97.39 a barrel. The contract is headed for a weekly climb of more than 1.5%. U.S. West Texas Intermediate crude was up $2.90 to $91.77 a barrel, and calls for a weekly gain of more than 3%. Both contracts rose as the dollar slipped. A weaker dollar boosts oil demand as it makes the commodity cheaper for those holding other currencies. While demand concerns weighed on the market, supply is still expected to be tight, with Europe's upcoming embargoes on Russian oil starting to slide in U.S. crude stockpiles. And in the metals market now, gold prices jumped more than 1% today, and we're headed for a weekly gain as the dollar eased. While investors look forward to U.S. jobs reports later in the day that could shed more light on the Federal Reserve's rate hike path. Spot gold rose by 1.3% to $1,649 per ounce. And for the week, the U.S. gold futures gained about 1.3% to $1,652. The dollar index fell 0.5%, making gold more appealing for other currency holders. Now to our next conversation. Ethiopia, Tigray regional and world leaders have hailed the peace agreement between Ethiopia's government and the Tigray rebels, raising hopes for an end to 2 years of brutal conflict marked by atrocities including killings and starvation. Let's look at the Ethiopian economy now that with Matt Kiniga, practice leader, Sub-Saharan Africa, front of you, join us via Zoom. Great to have you on the program.
Hi, Laddie. Good to be on the program today.
Yeah, so quite a landmark agreement there. What is the outlook for the conflict now that a truce has been agreed?
Yeah, well, it's worth remembering, first of all, that this is a truce and not a lasting political settlement or a peace treaty. And there is no guarantee, in our view here at Frontier View, that the truce will hold. And this is because there is a risk that we could see splinter rebel fighters launching attacks on the central government in the future. We could also see the lack of trust between the federal government and the TPLF, resulting in either side, claiming that the terms of the truce have been broken. We have seen a truce earlier in the year being broken in August this year, so certainly the outlook is incredibly uncertain. Having said that, the truce was largely expected, and this is because both sides are extremely keen to end fighting. The Tigrayans have a very strong interest in preventing the humanitarian crisis, which is pretty catastrophic, from getting worse. And also the federal government really wants to limit the damage that the civil war is causing to the economy and also to the country's international standing. So although we're not out of the woods yet for the conflict, and there is risk of fighting starting again at some point in the future, it certainly is a step in the right direction.
And what's your outlook for the economy now that we have this truce?
Yeah, so the outlook for the economy hinges almost directly, almost entirely on the outlook for the conflict. The conflict has taken a very severe toll on the Ethiopian economy. The country faces extremely severe foreign currency shortages, and in our view, this is because the government has been prioritizing foreign currency access for the procurement of arms, as well as essential things like food and medicines, but very severe foreign currency shortages at the moment. Inflation has also been above 30% year on year since at least the middle of 2021. So very difficult financial conditions there at the moment, and also investors are really holding back because of the conflict. So, provided that the truce holds, and provided that we move towards a peace deal, then the outlook for the economy will improve. Unfortunately, at the moment, our current view is that the economy will grow by only about 4% this year, maybe 5 or 6% next year, really driven by infrastructure investment led by the government. But we're not going to see the economy grow by the sort of 8 to 10% figures that we were seeing pre-COVID. So we should expect the economy to remain pretty weak in terms of compared to recent historical performance, as the effects of the civil war continue to weigh on investment and sentiment.
And I'm wondering, Matt, how are businesses, managing with the effects of the conflict?
Yeah, so the most direct effect of the conflict is the foreign currency shortages. Most companies are really struggling at the moment to access foreign currency, and in our view, this will persist for the foreseeable future until at least the conflict comes to an end. But what we're seeing, most of the clients that we advise, most multinational firms operating in Ethiopia, are kind of sitting tight for the foreseeable future. Many companies were increasing their investment plans in Ethiopia before COVID, and they had very strong ambitions and growth plans for the market. Most companies have put those investment plans on hold, although we're not seeing companies withdraw from the market, really. And this is because the economy continues to grow, even though it's much weaker than it was before the conflict and before COVID. And also the economy is a very large and largely untapped opportunity for many multinationals and many businesses. That said, the longer the conflict goes on, the less likely that companies will be able or willing to commit to the market. So we're all hoping for a much quicker end to the conflicts over the next year, so that businesses can get back to usual and invest more in the market. So certainly hoping for the best outcome.
Yeah, hoping for the best. But how has it affected trade, between, Ethiopia and their East African neighbors?
So data is actually quite spotty at the moment when we look at Ethiopia, although we are seeing relatively strong exports growth from the country. So despite the conflict, despite what's happening, and this is actually one of the reasons why the economy continues to grow, coffee exports have grown quite strongly over the course of last year, although most of the exports are directed towards other parts of the world, not necessarily East Africa. And actually, Ethiopia's economy is not that closely integrated with the likes of Kenya, for example. Most East African economies as well are not directly affected by, well, the trade between Ethiopia and East African economies are not directly affected by the conflict because the conflict is mainly sort of isolated and located in the north. So at the moment, it hasn't had a direct impact, but the risk to trade for Ethiopia is if we do see a resumption of fighting, we could see a bit of a disruption to the Djibouti-Addis Ababa railway line, and this is vital for Ethiopia's imports and exports. For the foreseeable future, we are likely to see a minimal disruption, but there is a risk to the outlook in that regard.
All right, thank you so much. I was Matt Kindiger there, practice leader, Sub-Saharan Africa Front Review. It's great having you on the program.
Thanks very much. Enjoy your weekend.
Thank you. You too. All right, now let's look at other stories. Now we see Kenya Airways pilots are planning a strike action for Saturday. That's actually tomorrow, to press on their demands to the management. The airline, partly owned by the government as well as Dutch carrier KLM, as one of the continent's biggest connecting multiple nations within Africa to Europe and Asia, is facing turbulent times. The Kenya Airlines Pilots Association said a series of meetings with the airline management had failed to resolve the pilots' grievances. Pilots who had a particularly fraught relationship with the management are pressing for the reinstatement of the contributions to a provident fund. And now the Monetary Authority of Singapore, Bank of Ghana, and Development Bank of Ghana have signed a memorandum of understanding to develop the Ghana Integrated Financial Ecosystem. The GIFE aims to enhance financial capabilities and access for micro, small, and medium enterprises in Ghana and generate greater opportunities for trade and financial services cooperation between Singapore and Ghana. And a coal-fired plant in South Africa that shot its last unit this weekend secured a $497 million from the World Bank and other funders to generate renewable energy from fossil fuels. The move towards cleaner energy is particularly complex in South Africa, which is chronic electricity shortages and the world's 13th biggest source of greenhouse gas emissions and has one of the highest unemployment rates. Financing comprises $440 million World Bank loan, $48 million in concessional financing from the Canadian Clean Energy and Forest Climate Facility, and a $10 million grant from the Energy Sector Management Assistance Program. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Enjoy the weekend.